All right, welcome. If you're getting ready for any kind of lending exam, you've got to master the Truth in Lending Act, or TILA. Seriously, it's the bedrock of consumer credit protection. This whole explainer is designed to cut through the noise and give you the absolute key concepts you need to nail those exam questions. So let's dive right in.
So here's our game plan. We're going to break this down into 5 key parts. First, we'll hit the core purpose, the why behind it all. Then we'll get into the nitty-gritty of advertising and the all-important APR. After that, we'll tackle the 2 special categories, high-cost and higher-priced loans. And we'll finish up with the consumer's ultimate safety net, the right of rescission. Think of this as your roadmap to acing TILA. Let's start at the beginning. Section 1, the core purpose of TILA. And here's a huge tip for your exam. If you really get the goal of a law, the specific rules make so much more sense and are way easier to remember. In this quote, it pretty much says it all. This is the whole reason TILA exists. It's to give regular people clear, standardized information so they can shop for a loan the same way they'd shop for a car. Every single rule we talk about today ladders back up to this one core idea: meaningful disclosure. Okay, pay attention here because this is a classic exam trap. TILA has 2, count them, 2 different definitions for a business day. For most general stuff, it's just any day the business is open. But for something super critical, like the right of rescission, it gets very specific. It means every single day except Sunday and legal public holidays. Knowing that distinction is absolutely crucial. And hey, the definition of a dwelling is probably a little broader than you think. It's not just a single family house. We're talking 1 to 4 unit structures, so that includes duplexes, and it also covers individual condos and co-op units. And get this, it doesn't even have to be attached to land. That's how things like mobile homes get covered by TILA. So here's a question you're almost guaranteed to see in some form. When does TILA even apply? The rule of thumb is super simple. TILA is here to protect people, not companies. So it covers credit for personal, family, or household stuff. It does not apply to loans for business, commercial, or agricultural purposes. You've got to know that line in the sand. That brings us right into Section 2, advertising and APR. If TILA's main goal is clear disclosure for consumers, then this is really where the rubber meets the road. Let's look at the strict rules of the road TILA lays out for how lenders can advertise. Okay, this next concept is something you absolutely have to burn into your brain: trigger terms. The best way to think about it is cause and effect. If a loan advertisement mentions any of the specific numbers you see on the left, like the down payment amount or what the monthly payment is, that triggers a requirement. They then must disclose all the other key terms you see on the right, most importantly, the APR. So what's the big deal with this APR thing? Well, it's not just the interest rate. The APR is designed to be the true cost of credit. It takes the interest rate and bundles it together with most of the fees and costs of getting the loan. It then boils all that down into one single number, so you can make a real apples-to-apples comparison between loan offers. It's TILA's #1 tool for consumers. Now this slide right here, this is pure exam gold. You are almost certain to get questions about what fees are in the APR calculation versus what fees are out. The general logic is, fees the lender charges to give you the credit, like origination fees and points, are in. Fees for third-party services, like the appraisal and title search, are generally out. Seriously, pause and study this table. It's that important. Okay, we're shifting gears a bit. Welcome to Section 3. We're now getting into territory with much, much stricter rules. We're talking about high-cost loans, which are governed by the Home Ownership and Equity Protection Act, or HOPA. These are the loans that raise major red flags and get the highest level of consumer protection. So that's the million-dollar question, right? What exactly flips the switch and turns a regular loan into a high-cost HOPA loan? It's not a judgment call. TILA lays out very specific, numbers-based triggers. If a loan crosses one of these lines, it's automatically classified as high cost, and a whole different set of rules apply. Let's see what they are. Here is the first magic number you need to memorize. It's the APR test. If the loan's APR is more than 6.5 percentage points higher than the average prime offer rate, which is basically a benchmark for what top-tier borrowers are getting, then just like that, it's a high-cost loan. And here is trigger number 2, the points and fees test. If all the points and fees the borrower has to pay add up to more than 5% of the total loan amount, that also makes it a high-cost loan. The dollar amount you see here gets adjusted for inflation, but that 5% figure, that's the number to lock in for your exam. So what's the big deal if a loan gets tagged as high cost? Well, a bunch of new rules kick in. First, some really risky features are just plain banned. Things like balloon payments and negative amortization. And you need to burn this into your memory. Prepayment penalties on a high-cost loan are always prohibited, no exceptions. Second, there are new requirements. The borrower has to get special disclosures 3 days before closing and must complete HUD-approved housing counseling. These are non-negotiable. All right, moving on to Section 4. There's another category of loans that kind of sits in the middle. It's not quite a standard loan, but it's not a full-blown high-cost HOPA loan either. These are called higher-priced mortgage loans, or HPMLs. They don't have quite as many restrictions as HOPA loans, but they still come with extra safeguards for the consumer. As you can see, the thresholds for an HPML are a lot lower than for a high-cost loan. For your typical first lien mortgage, just being 1.5 percentage points over that APOR benchmark gets it this classification. And the single most important requirement to remember for your exam is this. HPMLs require a mandatory escrow account for taxes and insurance. The whole idea is to protect the borrower from payment shock when those big bills come due. And that brings us to our final and incredibly important section, the right of rescission. You can think of this as the consumer's ultimate safety net. It's a cooling off period, an undo button. It's a really powerful protection. But you have to remember it only applies to specific situations, mainly when you refinance a loan on your primary home. Now check out this timeline. Under normal circumstances, the borrower gets a 3-business-day window to just cancel the whole deal, no questions asked. But here's the kicker, and this is a huge deal for compliance. If the lender messes up, if they fail to give the borrower the proper disclosures or the notice about their right to cancel, that right suddenly extends for up to 3 full years. That is a massive risk and a critical detail to know. So what happens if a borrower decides to rescind? The process is simple but very strict. The borrower just has to give the lender written notice. From that point, the lender has 20 calendar days to return every penny the borrower has paid them. We're talking origination fees, appraisal fees, everything. The whole transaction is basically erased. So as we wrap all this up, I want to leave you with a question to chew on. TILA's original goal was so simple. Make credit easy to understand and compare. But after going through all these layers, trigger terms, APR calculations, HOPA, HPMLs, rescission rules, you have to wonder, does the sheer complexity of the regulation itself become a new kind of barrier for the very people it's trying to help? It's definitely something to think about. Good luck on your exam.